Hello, all. Good evening and welcome. I'm Kabir Sohi from the Corporate Communications team of CareEdge. I welcome you to our discussion today on microfinance in India. Is the first behind. We sincerely appreciate your joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Ms. N. Nirja, Managing Director, Napkins. Mr. Vineet Chhatri, Managing Director, Swatantra Microfinance Private Limited. Mr. Rakesh Kumar, Chief Executive Officer, Light Microfinance Private Limited. This session will be moderated by Sanjay Agarwal, Senior Director at CareEdge Ratings. We will commence the session with a presentation by Jatin Arora, Assistant Director at CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Jatin Arora to make the presentation?
Thank you, Kabir. Hello and a very good evening to everyone. I welcome all our esteemed panelists and audience for taking out time and attending this webinar by CareEdge Ratings. We will shortly be having a Q&A session with our panelists after this brief presentation on NBFC MFIs. Microfinance is more than just small loans. It's a powerful tool for financial inclusion and poverty elevation. Over the past few decades, this sector has transformed millions of lives by providing access of credit to those who were traditionally excluded from the banking system. Today, we'll be exploring current trends in this sector. This presentation broadly covers four parameters. One, the decline in scale of NBFC MFIs and microfinance sector in India that we have seen in past 1.5 years. The asset quality metrics showcasing slight improvement in NPA numbers in H1 FY26. Third, weakened earnings profile of NBFC MFIs, largely on account of increase in credit cost, elevated operating expenses, and some margin compression. And fourth, overall funding for MFIs and capital profile of these entities. Let us first see the impact on scale and operations of MFIs. In last 1.5 years, the disbursements for the microfinance industry have declined, primarily on account of shift of focus of lenders towards making recoveries rather than growing book, and further by self-imposed guardrails leading to higher rejection rates. During H1 FY26, the sector witnessed total disbursements of rupees 1.18 lakh crore, which were down by approximately 19% on a year-on-year basis. With these lower disbursements, along with the write-offs that the lenders have done during this period, the overall scale of microfinance sector in India declined to around 3.5 lakh crore in September 25, registering a YOY decline of approximately 15%. Following the similar trajectory, the AUM of NBFC MFIs has also witnessed similar degrowth. For MFIs, their AUM stood at rupees 1.3 lakh crore in September 25, which constituted around 39% of the entire microfinance sector in India. The cautious stance adopted by NBFC MFIs, as seen in lower disbursements, is reflective in recent asset quality numbers. The forward flow rates have come down across various buckets, from 2.1% to 1.7% for the first bucket, from 45% to 40% in the second bucket, and so on and so forth, as we can see in this slide. While the trend is promising, the slippage rate remains elevated from a normal scenario. A monthly forward flow of 1.7% translates into an annualized forward flow of more than 20%, and hence, further continuance of this downward trend is important for the entire sector to reach back to its normal levels. This decline in forward flow, clubbed with incremental write-offs that the industry has seen in H1 FY26, has helped it reduce the NPA levels. CareEdge Ratings estimates the NPA to have come down to around 3.7% in September 25, down by around 100 basis points compared to March 25 NPA levels. This decline seems to be majorly driven by the write-off that the players have done. Looking back at the overall stress that industry has seen so far in this cycle, in relation to the micro MFI's AUM for March 2024, they have written off or transferred to ARCs an amount of approximately 8% of that AUM. in FY 2025, while around 7% was still carried on their books in form of stage 2 and stage 3 assets as on 31st March 2025. CareEdge Ratings expects that while the worst may be behind us, the recovery will be gradual. We at Care expect the NPAs to further decline by around 70 basis points in second half of this fiscal on account of incremental write-offs and expected growth towards the year end. Another comforting sign for asset quality is decline in portfolio towards borrowers with more than 3 lenders. The share for the same has declined from around 13% in March 24 to around 9% in September 25, demonstrating reducing over-leveraging. This reduction in share of over-leveraged borrowers is largely driven by guardrails imposed by SROs and write-offs done by the entities, wherein the return of pools would be comprising of these over-leveraged borrowers. With this reduction in over-leverage exposure, the new book generated by MFIs is expected to perform better. Now, moving on to the earnings profile of the NBFC MFIs, the increased stress that the sector has seen in past 5 to 6 quarters has acted as a triple whammy on the profitability metrics of MFIs. MFIs witnessed an increase in their credit cost on account of elevated delinquencies, increased provision cover, and higher write-offs. Further, MFIs witnessed a reduction in margins also due to interest reversals on the pools that they had to write off. And thirdly, MFIs had also to incur higher operating costs to strengthen their collection team and contain field level attrition. After covering trend and scale, asset quality, and earnings profile, let's move on to the funding profile of these entities. In terms of debt funding profile, banks have remained primary lenders for MFIs. However, we can see a marginal movement from share of NBFC funding towards ECB financing for NBFC MFIs. Further, in past few months, some entities, especially the smaller MFIs, have faced funding challenges, and hence they were forced to raise funds at higher rates also, further impacting the margins that they were earning. Given the slower growth and current collections in the sector, liquidity seems stable for now. However, funding conditions will need close monitoring. Another comforting factor for the sector is the overall capitalization profile. NBFC MFIs had a debt to equity ratio of around 3.1 times in September 25, down from 3.6 times in March 24. The reduction in gearing can be attributed to two primary factors. One, reduction in scale and hence the on-book debt. And second, the capital raised by some players during this period. CareEdge Ratings does not foresee any major capital requirement for the sector in the near term. The next slide here captures CARE's coverage on the NBFC MFI, the distribution of ratings that CARE has on NBFC MFIs. At present, CARE rates 20 NBFC MFIs with the median rating of BBB+. Due to sectoral issues that we have seen during last 1.5 years, CARE Ratings had taken 11 rating actions on downside in FY25, approximately 50% of the cases. The downward actions include not just downgrades, but some rating outlook revisions also. For H1 FY26, the count is 5 so far. The next slide captures CARE's outlook on the key parameters of NBFC MFIs. After witnessing a degrowth of around 14% in FY25, CareEdge Ratings expects the growth to return in FY26. However, the same is expected to remain moderate at around 4% for the entire fiscal. Further, CARE estimates NPAs to decline by 170 basis points in FY26, while credit cost will remain elevated at around 6.1% in relation to their average total assets, although that would be down from 9% number that we saw in FY25. Overall profitability of MFIs is expected to remain weak in FY26, while improvement is only expected from FY27 and onwards. CARE also expects funding to improve for MFIs in second half of this fiscal. However, liquidity will remain monitorable, especially for the players with a high share of borrowings where financial covenant breaches have happened. No major capital requirement as such is expected for the sector in the near term. To conclude, CareEdge Ratings expects that while the sector has faced significant challenges, early signs of stabilization are visible. The next 12 to 18 months will be critical for restoring profitability and sustaining growth. I thank you all for your attention and now hand it over to Kabir.
Thank you, Jatin. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Sanjay Agarwal to take over the session, please. Sanjay Agarwal is a senior director at CareEdge Ratings. He is currently the head of PFSI ratings vertical of CareEdge Ratings. Sanjay has over 3 decades of experience in credit ratings and financial services. By education, Sanjay is a chartered accountant with all India ranks in intermediate and final examinations. He has cleared level 2 of FRM and also qualified the final examinations of erstwhile Institute of Cost and Work Accountants of India. Over to you, Sanjay.
Thank you, Kabir. I also thank Jatin for the insightful presentation. To begin with, it's my pleasure to introduce our esteemed panelists. So, our first panelist is Mrs. N. Nirja. She is the managing director of NAPFINS. NAPFINS is a wholly owned subsidiary of NABARD and is engaged in microfinance. Srimati Nirja is the postgraduate in applied and analytical economics and CAIIB and holds a diploma in management. She joined NABARD in 1992 and has varied experience and has worked across various offices of NABARD at Hyderabad, Bhubaneswar, Bhopal, Chennai, and at the HO in Mumbai. Welcome, ma'am, to our webinar. Next, this is Mr. Vineet Chhatre. Vineet is the Managing Director of Swatantra Microfinance Private Limited and is the Chairperson of MFIN, which is the SRO for microfinance industry. Swatantra is one of the largest MFIs of India. Vineet has a rich experience of more than 30 years across operations and management consulting in India, US, and Middle East. He is a chemical engineering graduate and has 2 degrees in business administration and business laws. And he's also attended the executive program in the Wharton School. We will welcome Vineet also to our webinar. Our next panelist is Mr. Rakesh Kumar, who is the co-founder and CEO at Light Microfinance. Incidentally, Rakesh is among the pioneers of microfinance industry in India. He holds a master's degree in rural management from Institute of Rural Management Anand. Welcome Rakesh to our webinar.
Thank you, Sanjay. Very good afternoon to everyone.
Thank you.
Good afternoon, Sanjay.
Thank you. Before we start, a quick disclaimer for the audience. Our panelists are experts and veterans of the industry. The views expressed by them in this webinar are their personal views and do not represent the views of the companies or firms with which they are associated. So to start with, let's have a round of opening remarks. So Mrs. Nirja, ma'am, could you start with your round of opening remarks on the industry?
Good afternoon to all, and thanks, CareEdge, for having me here. Definitely, we have been in the microfinance. Actually, we celebrate our 18th foundation day today, and we have been there in business as an NBFC first and as an NBFC microfinance for the last 10 years. We had started our business with bulk lending, which opened to direct lending branches, which we have about 500 branches today. As was the industry, let me get directly into the issues. As was the industry, we definitely felt the stress last year, as everybody did. But we have quickly brought our book to order, and we have had a reasonably good year during the current year. Though there has been a decrease in business, there has been improvement in our NPAs, and we have doing better than what we did last year. So we are very optimistic of the future of both microfinance as well as our own company. That is I would be my opening remarks.
Vineet, could you give your opening remarks, please?
Yeah, thank you, Sanjay. And I would, while of course we will discuss about the sector in detail, but I think one of the things that we need to understand that if at all we think about the Viksit Bharat dream and the target that we have in 2047, it is only possible if we actually have an equitable and sustainable development. And financial inclusion remains the bedrock for the same. This sector, NBFC or the microfinance sector, today caters to more than 8 crore customers. And in by definition, assuming that you have about 40 crore of population. And this is therefore very important in terms of NBFC as an advance. If you look at it, when we talk about the entire NBFC sector, while this sector may be 8% of the total advance of NBFC, but it is about 30% of customer. It's very important that the sector continues to make this impact as we go ahead because journey is not yet over. It has, in a large extent, has just begun and is also metamorphosing with the needs of the customer. So therefore, the importance of the sector cannot be taken away. And then another two small points is that this is also one of the most unified, or what we say as a sector amongst the responsible lenders, who actually are A, most transparent, and B, probably the only example in the sector of lending where all the people have come together and self-imposed the guardrails to take care of the customers who are actually the bedrock of our economy or the grassroots entrepreneurs. I will stop here in generally just putting that importance of this sector, and it's very important to recognize that.
Well said, Vineet. Rakesh, could you start with your opening comments, please?
Thank you, Sanjay. So I think both the esteemed panelists have covered the opening remark. I would only add here that see microfinance. Apart from one thing we should be not forgetting that we are one of the, I would say, not as seasoned industry as other asset class. So microfinance is still, if you compare with other asset classes, new, but yes, has been rapidly growing and it has survived many, I would say, shocks and crises earlier. Uh, Microfinance is evolving. It has been resilient. And if you compare the evolution of different asset class, I would say, microfinance has been much more resilient and it is needed. Like Vinit was talking about Viksit Bharat and, you know, the kind of growth which is required for NBFC as a whole and the contribution NBFC MFI is going to do is immense. So it is not only, I would say, a very huge potential. It is a responsibility for all the stakeholders to take the entire industry, NBFC industry, including the MFI, to make it much more stronger. And I hope from this discussion, definitely we will get very good points to ponder. Thank you.
Yeah, thanks, Rakesh. So, very good set of opening remarks that the industry itself it's growing and it's not very developed or not very evolved, but still evolving. But having said that, it's in cycle and is resilient and targeting the bottom of the pyramid, like Vineet said, probably 8% of the assets, but 30% of the customers, and essential tool for financial inclusion. And that's, I think, the point the presentation had also met. And as Madam said, the asset quality issues are there or probably slightly behind us, but there has been a degrowth in the recent past, and probably that is what the industry probably will now need to get in track with it. So now coming to our questions, I'll start with Vineet first. So how does the overlap of borrowers in MFI and non-MFI segment, let's say LAP, gold loans, personal loan, etc., complicate the MFI risk assessment?
So, under the new guidelines which RBI had come out in 2022, and I'm sure all of us are aware of it, that The new guidelines, for the first time, RBI has come out with an asset-based guideline than the regulatory-based guideline, right? And they defined microfinance as a sector, as a class where any unsecured lending that has to be given with a household income of less than 3 lakh is a microfinance loan. And there is very clear definition in terms of calculating the FOIRs, or rather what we call as fixed obligation to income ratio at a household level. So as we speak today, all the players in microfinance actually are not just looking at the obligation of microfinance, but also, by the way, looking at the entire obligation of household, be it secured or be it unsecured. Now, therefore, what has happened, and which is actually a right way, that as the customers are maturing, of course, they will have more and more nature of credit demand. Be it secured, be it vehicle, be it tractor, be it gold, be it another areas. Also, channels of credit are increasing to each and every one as we are all going up on the value chain of technology. Essentially, therefore, it has even become more imperative that we all remain careful to assess the obligation of households at the last level, and therefore we all actually look at consumer retails and look at those obligations, and then, by the way, are very clear that the FOIR of 50% is maintained before we lend anything. This is also one of the reasons why, in fact, in the SROs and the MFIN guardrails have also a part of the takeaway in terms of converting some of these things into proxy. But this is something which has become a bedrock. Yes, of course, as we go ahead, these overlaps will keep on increasing. I'm not sure that this will ever decrease, right? As more and more credit demand, as more and more types of utilization and the needs will arise. The question remains is that we need to be cognizant of it, and we need to make sure that none of our customers are over leveraged in under any circumstances because of this overlap if it is increasing. It's not about microfinance. At the end, it's about customer. And it's about the customer's ability to repay. It's never about lender. It's always about the customer's ability to repay. And that has to be the central constraint, central theme if we were to consider ourselves a responsible lending. I'll stop here, Sanjay. I hope I have been able to answer your question.
Thank you. It's very well said. So you are saying that the FOIR become the bedrock of encompassing all the type of various types of loan by the family and of the household, and then look at the ability of the household to repay the loan, including the MFI loan. So the whole focus shifts onto the customer assessment rather than the type of loan they have given and who has given the loan, etc.
Absolutely.
Yeah, very well said. So, and we now move to Rakesh. So, how is the collection trend? Many of the questions actually are on asset quality and related issues. So, and as the given the mood of the industry, probably that was expected. So, yeah, coming back to the question for Rakesh, how is the collection trend in the industry at present? And when would you see stability? And what would, more importantly, what would stability look like in
Yeah.
terms of the collection trend?
Yeah, so collection trend, basically, I would say all of us would agree that it has been improving month on month, and it is very near normalization. Yes, if you look at the entity or geography, you can see variations, but definitely, it has improved, and it is definitely giving a lot of confidence. In these 3 months, I think uh, Light as well as all the industry players, they have been able to observe and understand the reason for the lesser or higher delinquencies, and it was little different from the seasonal crisis. It was being said structural in nature. Of course, I mean, we will have to go little detail when we talk about over leveraging. So definitely, I think the entities have worked on their credit criteria. They have tweaked their credit underwriting. They have run many analytics on different pools for basically reorienting the team for collection and follow up and monitoring. At the same time, they have been extremely cautious on selecting the customers for the disbursement. So that's the reason we are able to see a very definite and I would say comfortable improvement in collection. But yes, we are still, we cannot say that we have reached the normalization. It is yet to be reached. But with the steps which we have taken at SRO level, MFIN level, the guardrail, and the increased realization of small, medium, or even big, all the big players. So I think we are moving in positive direction, and I think we will see in coming days much better collection, much lesser credit cost.
Okay. But what do you think would be a new normal for stability? Like, do you expect it to come back to the old levels, or there would now be slightly higher, let's say, or lower collection efficiency than was historically been there?
See, I mean, if you look at, uh, I mean, it is not difficult to understand. Uh, 10, 15 years back, the size of industry was only 15 to 20,000 crore. Now, even after degrowth, we are standing at close to 4 lakh crore. So definitely the size of the asset class has increased. Many new companies have entered into the space, and after harmonization of rule by the RBI, definitely the complication has reduced. But all these, the increase in and number of entities will definitely. And if you look at the delinquencies, the credit cost, quarter on quarter, year on year, so it is bound. It is not only in microfinance. If you look at the contribution of all these factors, so equilibrium will set somewhere. So to answer your question, the short answer is, see, I mean, we should not expect the credit cost to remain at older days. It will increase, but at the same time, with the advent of technology, I think the industry is making very good and welcome changes in the model, and operating cost is likely to reduce. So that will definitely, we will be able to accommodate the even slightly higher credit cost.
Yeah, ma'am, again, taking up from what Rakesh has said, so what is the expectation for credit cost? Like, what do you think will be the new normal? So, in terms of the credit cost, would you like to guess any figures or just state a sort of objective out there? You're on mute, ma'am, right now.
That our credit, considering that our credit cost also increased last year, and we were also grappling with what the figures would be during the current year, considering that we have to set a benchmark for ourselves. We had last year, actually, our credit cost was at about end of the year about nearing 4%. I'm sure much lesser than what the market average that was shown in the presentation earlier. As on date, today also it is a little more than what it was, because considering the amount that was outstanding last year, we are still to write that off. So it continues to be above 4%. But going forward, in the medium term, we see for our company at 3.5% and probably going to 2% in the year 2027. But having said that, there are other issues that the industry is grappling with. So considering all of that, I think credit cost is an important component, considering that there was a decrease in repo, even though there was a decrease in the base rates. Most companies have increased their interest rates mostly because of the credit cost part of it, because operations and other things remaining constant. I think we should work towards decreasing the credit cost, and I think all of us are working towards it with improvement in the quality of assets and decrease in NPS. I'm sure that will decrease, and definitely less than what it was in 25.
Yeah, again, both the panelists have discussed the technology, so I would like to ask Mr. Vinit Chhatre that has the use of technology been able to help you reduce the OPEX or the operating expense ratio in the last couple of years?
So there are two types. This business, microfinance business, is a very high touch business. And I'm sure all the panelists and everybody agrees to that, right? And therefore, we don't call it as a digital lending, we call it digitalization of our processes. That has been the first objective of all the microfinance entities. So if you see today, the entire the so-called customer onboarding, the customer servicing, to a large extent, the grievance redressals, to a large extent, the audit processes and risk monitoring, they've all become to a large extent digital, right? Now, while all the processes have become digital, the only thing which we have to also understand that and the entire disbursement in microfinance industry, and we are actually absolutely sure and we are happy to say is 100% digital, which is actually in the banks of the customer. The collection part of it is the only one which is still mix of is a largely cash because the customers are also slowly evolving as they keep their banks funded, as they get more and more on the smartphones, and as they get more and more on the net banking, these things will evolve. As we speak, they're evolving continuously. As and when the entire spectrum on both sides gets digital, naturally the cost, essentially, or the operating efficiencies of the system will improve. So technology has helped us to lot to reduce our operating costs, our processes have got digitized, but then the last leg or the touch with the customer still remains. And by the way, even if our collections become digital completely, at least there is a school of thought that this business still needs to be in constant touch with the customer. We are at the end of the day completely unsecured nature of lending. An unsecured nature of lending does require a very, very strong or a robust interface and connect with the customer. That will never go. So there will be a certain limit to which these costs will come down, but they will not be able to coming down like, for example, other asset classes. For example, if I were to take housing, there is a mandated cash collection, right? Once you actually take a home loan, after that, anytime you see the bank or the custom or the lender is at the time when we are pre-closing it, or you want to pay something, or there are some concerns, right? Otherwise, there is an NACH mandate which comes to your bank and the EMIs are deducted. Will this ever happen in this asset class? Answer is no. We will still remain in terms of so-called collections because mandated collections will not happen. So therefore, the operating cost will remain up to a certain level, will not go down below that. But yes, is there a scope? Obviously, there is a scope to further reducing it. So technology has already come on our inside homes. It is now slowly becoming a part of our interaction with the customers. And over a point in time, our interactions of customers will slowly and slowly keep on going higher on the technology bandwagon.
So now we have a very interesting concept of CX. So probably the CX would remain phygital for MFI,
Come again,
but
please. Sorry.
the concept of CX, customer experience, uh,
Yes, and
that would
please
remain for the
understand one
future.
thing. A lot of us sitting in this, the mobile penetration, of course, has increased significantly in rural India. But I'm sure Rakesh would agree with me and ma'am would agree with me that still a lot of our customers are on what we call as not on the smartphone, on the digit phones, right? They still need to get onto the bandwagon of what we call as net banking. Like you and I don't visit our branches, we are always on our net banking. They still have to adopt those practices, get comfortable with the technology, understand technology. Let's look at even our generations behind us. I can talk about our parents and they still are not as savvy as probably you and I would be on the net banking transaction. We are talking about rural India slowly coming on that curve. So the customer experience is slowly, we are all trying to, for example, we have a customer app in which she can go observe her rate, loans. She can actually see what is the status. But will she be absolutely able to get onto the digital bandwagon to serve her loan? That will take some time. One need to also be cognizant of a very important factor. The technology today is running faster than what I and you can even comprehend. And by the way, as the technology moves faster, it also opens up the area of vulnerability. One need to be very, very careful of this point that as the technology goes up and the gap between understanding technology and doing your regular work increases, you can fall through. And it is our responsibility to make sure that the vulnerable customers are not getting into the digital frauds, or they are getting open in terms of creating a lot of digital footprints which make them vulnerable. So the adoption should be a slow, should be knowledge based, and then comes the utopia. It cannot be done overnight.
Okay. Yeah, I think that feature of the industry will remain, that the customers, underlying customers, are vulnerable portion of the society. So everything has to evolve around that. Now, coming to the back to the asset quality. Rakesh, is a question for you. In terms, if I want to look at a single indicator to assess the asset quality, what should I look at? Should I look at zero plus DPD? Should I look at stage two? Should I look at gross NPA? If I want to look only at one figure, so what is the key figure according to you, or should we necessarily look at quite a lot of figures together?
I'm not able to understand why we are looking for only one indicator. Because at the time of crisis, I would like to have a lot of data. Good part in the industry is that at least with this new set of RBI guidelines, we had been by regulation, we were required to collect the household information, including the cash flows. So the access to database, you can perform a lot of operation, lot of analytics. Even we had been running quite interesting analytics to predict the default based on the delinquency behavior of all the customers, because we had been collecting data of the household even before RBI talked about it. So there is huge possibility. Coming to your answer, if I am forced to pick one, obviously, I mean everyone would agree. I would like to see what is the one plus or zero plus DPD, because in microfinance, the I would say turnaround time is lesser, right? If the customer default goes beyond 30-60 days, then it becomes very difficult to get the collection, especially during crisis when your operating model breaks. So we always look at zero plus, but at the same time, we should also be looking at not only the these bucket numbers, but also the reason behind it. Why the default has happened. Looking at the heat maps, looking at the geographies where delinquencies has gone up, and what are the reason? What are the genuine reason? What are the man-made reason? What is the economy? If the problem lies on customer side, then what kind of underwriting had been done, and some of those findings, if applied, it definitely strengthens collection. So I think we should not rely only on a couple of indicators. We should get to the bottom of it if we want to improve collections.
Okay, so yeah, there's an interesting thought that collection figure, I mean, the zero plus figure, while it's an important indicator, but we'll have to do much more analysis and discussion. But the question is, I think, in terms of general analysts, we're getting a lot of questions out here. So one question, probably Rakesh, you could answer is that some MFI companies perform better given the headwind in the industry, and some don't. So how common is evergreening, or is there any difference in practice of, let's say, reporting NPAs? Would you like to, is it especially for Rakesh, since Vineet is a part of MFIN, so I'd like to ask this only to Rakesh.
I think, Rakesh, sorry, I mean, if you see, I think
Please.
the idea is, I think it's not about, see, RBI is very clear, and all of us are actually monitored by RBI, right? By the way, anytime all our loans which we give, the st- the status of the loan before we give is monitored by RBI on an annual basis by all the entities, right? So therefore, using the word that there is an evergreening is something that I would rather essentially object to,
Okay.
right? Uh, this business is about, ultimately, in microfinance, at the end of the day, the difference in the performance of the microfinances industry companies is essentially based on only three factors. First, how strong is your governance practice? If your governance is in the right place, you would always have a long-term gain. Second, How strong is your risk analytics, which Rakesh was talking about? Are you able to proactively see heat maps or the areas where you can actually take proactive steps? And by the way, calibrate your disbursements. And the last but not the least is absolutely strong control on processes. Because let's be honest, in this business, it's about adherence to process that matters much more than your ability to underwrite, because this customer is still of a lot of informal segment. You don't do underwriting on cash flow basis in this customer set. It's about the behavior. It's about the location. It's about the other analytics things. So therefore, governance, risk analytics, and process adherence. These are the three reasons why one entity would differ from other, right? These are the fundamental reasons. It's not about A is reporting or B is not reporting. There are statutory auditors, there are RBI auditors, there is rating agency. There are enough and more people who are evaluating this whole thing actually on a regular basis. I mean, Rakesh, you want to add
Yeah,
something,
I
please?
would only like to add. See, I mean, we forget again and again that microfinance is a very different stage of evolution. If I have to compare the length of a 5-year-old kid, among 5-year-old kid, then you would see a lot of variation because some of the five, that is a growing age, right? But once the industry gets matured, right, when everybody has grown enough, then definitely that comparison would be fair. So having said that, see, I mean, any asset class in any industry, the response to crisis is different for different entities, and none of them are wrong, because it is the response. Our response means Vinith's response to crisis might be different from us, and we might get partial success. So it is just like that. So I would say, see, I mean, in lending business, when you have to go full throttle, when you have to stop, when you have to observe, especially in crisis situations, how you are taking your delinquencies, how much you have understood, what is your focus, what kind of balancing strength you have, provide for risk. So depends on various factors how you are taking it, and of course the industry is learning, right? And I'm sure, I mean, all this crisis after crisis has made each of the entity players much more mature. That's the reason we are gaining confidence, and we know that we will emerge even strong.
Okay, thanks. Yeah, so a lot of the audience actually, I think, have questions on that. So another set of discussion, Nija ma'am, is that how do you see top-up loans? Is there a possibility that top-up loans are being used optically to improve the asset quality figures?
Yeah, I
So
think
that's
taking forward what Vineet and Rakesh ji, both of them have said, this is internal to a company exactly how they give additional loan. I'll not call it a top-up loan. If there is a requirement of a borrower or existing client for a loan for a specific purpose, then it is up to our duty to cater to that. So that is how we cater to that is our responsibility. Whether we can give such a loan to an existing delinquent customer or not, it is our internal policy. As on date, we don't have a policy, and I'm sure most of the MFIs would not like to do lending to an already existing delinquent customer. The evergreening part will come only if you are looking at giving additional credit to a delinquent customer, and considering that there are guardrails in place, and then we are monitored by the SROs, and there are inspectors from RBI, statutory auditors, and many other entities that are looking at us with a microscope on a daily basis. There is no way that we can look at top-up loans for delinquent customers. Whereas I would say that giving a loan, additional loan to an existing customer within the group or with outside it, when there is a genuine need and we look at the underwriting and we are doing proper underwriting, I don't think there is anything wrong with it. And I'm sure the industry also does it on a daily basis. That is with regard to, so there is no, doing top up loans is not a crime. How we do it is what we need to see.
So that also probably will depend on organization to organization. But as you said, industry generally is reticent in giving additional loans to customers who are already delinquent, and that probably is more of the industry standard rather than the exception.
It's not only because it's not only about delinquent customers. There are also guardrails which say how much delinquency, whether there was a write-off earlier, whether there was an OTS. All these are data points that are looked into before we are doing a lending, whether it's
Correct.
top-up or general lending. So there are so many things in place to ensure that we are not over-lending, and also we are not lending as a top-up loan for evergreening any account.
Yeah, okay. So now coming back to the financial portion of the business. So for Mr. Rakesh Kumar, has the sector fully provided for delinquent or stressed assets, or will the industry have to provide more over the next, say, 2, 3 quarters for the assets which are already on book? And the other question is that is there a variance in the way the write-off or the provision has been made amongst various players? The same question keeps coming back. Yeah.
Yeah, if you look at I was just looking, I didn't get much time to look at the second quarter's result, but was just trying to take a look in the morning. So there has been what I have observed that majority of the institutions have adopted, two approaches. Either they have fully provided, couple of them I saw fully provided, or they have, done a write-off, which clearly can be seen from their credit cost and GNPA. Uh, but I would say, there is enough indication that the delinquencies will be lesser and credit cost will start stabilizing. So, to answer your question, the picture will, I think, become more clear by the end of this financial year. But and of course, and there are a couple of entities for whatever reason, they have higher credit costs. There is no doubt about it. All of us are aware about it, but they are also doing something about it. And I'm sure, by year end, the picture will become clear. But to answer your question, there has not been a very standard practice, and it also, depends on the stage of balance sheet, right? And of course, the requirement of the organization, also their target, like annual operating plan. What I can definitely say that none of the entities in the sector are looking at aggressive growth. They have been trying to achieve a normalization. uh, Quarter on quarter or maybe yearly performance target might change in terms of provision or write up, but I think everybody is moving towards normalization.
The question is for Vineet now. So, what do you think would be the normal rota chain for the MFI? Means how should it look like in terms, let's say, margin, OPEX, credit cost, and profitability?
Yeah. So before I answer that, I must tell you two things. One is that please understand in the microfinance industry, given it's unsecured, you have 100% risk weightage compared to every other asset class where risk weightages are not 100%. Number two, this industry has a highest PCR, which is the provisional coverage ratio across the segment because of the higher LGDs that we provide. Number three, most of the large MFIs have a very clear policy of writing off in 180 days, so we don't carry anything beyond. So therefore, to a large extent, at any point in time, is adequately provided. And this industry has actually taken India's way back, of course, like all other NBFCs from 2020 onwards. So therefore, to your extent, whether they are not or not to a large extent, all the large entities have actually kind of taken the adequate provisions by the nature of or by the virtue of this whole thing. I agree with Rakesh that somewhere there could be variation in practices become the constraints of natures that could be different. Coming back to your question on the rota, essentially, if you look at it over the last over the last 8 years, the standard rota across the industry has been about 2.8 odd percent or 3%. In fact, which essentially transmits itself to an ROE of about 14.5% across cycles. across cycles. And this number is something that you can actually look at it. Now you're seeking a bad cycle now. There would be a good cycle. And by the way, cycles in this industry do get constrained by two reasons. These are not housing finance cycles. Please understand our customers do get impacted by various elements. It could be natural. It could be external. It could be various other things, and the cash flow does remain vulnerable. And therefore, the cycles are smaller, but also the quick resilience of this sector is also very sharp, right? Unlike housing bubbles, when the housing bubbles happen, the economies go down and take years to come back. The resilience of our customer is that cash flows get impacted, cash flows do come back because at the end, we are catering to the entrepreneurial set of customers. So therefore, the reason why we all say that this is a resilient site, these are the resilient set of sector is nothing because of us, but because of our customers. So will the rotas on an average, I'm just giving you a statistical number, you can go and check that. Over a period of time, some of the large listed entities, you can always check that their ROEs are on an level of about 14 to 15% across the cycles, which again, if I look at advanced to leverage ratios of about roughly about 3.5, you would actually come to the same number of about 2 and 2.8 to 3. That's the standard rota across the cycles. At now, if you were to ask me what is going to be this year, what's going to be the next year, the answer will be very company specific, can't be generalized. But if you look at across the sector, that's the general answer for you.
Oh, yeah, so you're saying 2.8 is a benchmark,
That's
probably
that's the
even
that's the
this.
that's the statistics. I'm not saying it's a benchmark, right? Benchmark is depending on the context, right? I mean, for us, it will be different this year. Over the last year, this year, we have been very stable. It will be probably now only on the increasing trend. But it depends on company to company, to be honest, Sanjay. You can't generalize it, but statistically generalize karenge to over the last 7, 8 years, that's the number that we have seen.
And yeah, yeah, well taken. And the next question is to Mr. Rakesh Kumar. So do you see a need for MFIs to diversify the resource profile away from the banks? And has the marginal cost of funding moved up, down? How is it?
Yeah, I mean, uh, I think the SROs and industry players were already, trying to convince regulator, and thankfully, the Reserve Bank has issued guidelines some time back. They have, reduced the qualifying asset requirement to 60%, which is a welcome step, and we see the benefit of that. But at the same time, we at industry level keep coming across the discussion. What we are talking about that, yes, there has been room, but it should be meaningfully utilized. And before getting into, say, secured or unsecured, or maybe getting into other asset class, we should be properly, trained. We should be having the resource. We should getting slowly, then only we can take the benefit. And in fact, some of the entities, the bigger entities, they were already doing it, so they have tried to increase their diversification. But yes, it is a welcome step, and it will definitely strengthen the overall balance sheet of the MFIs. uh, uh, Much depends on how they are doing it.
So we have actually a follow-up question on that from the audience. So now that the qualifying asset requirement has been brought down from 75 to 60, a lot of the MFIs are going for small ticket labs or business loan. But incidentally, these segments are also under stress right now. So means are we getting into a equally stressful situation by getting diversifying, or is there any benefit out there?
So that's the reason I said that how you are approaching, if you are getting into lab, or if you are going into individual high ticket loan, or if you are getting into secured category, the key lies in, because see, microfinance companies have developed their expertise for unsecured lending, right? With much less data. But in if we are moving up in the ticket size or getting into other asset class, it's important that we should know the credit underwriting well. We should be giving us sufficient time to understand, observe the asset class behavior, then only we should be, thinking of growth. So I think RBI Reserve Bank has just relaxed the guideline. Entities have started, thinking about it, and I'm sure, that part will also evolve. And of course, I mean, it is definitely a welcome step. It will definitely strengthen their balance. That much I can say.
Ma'am, there's a question from the audience out here. So the SRO has created a restraint in terms of number of lenders per borrower, as we have heard in this discussion also, and borrowing per borrower. So many of the borrowers would be expected to scale down, and we have seen the industry degrow by 17% in the last 1 year. So when do you expect the growth to return back to the industry?
Microfinance, as growth in the microfinance, there is a degrowth in all of the companies, and I don't think that will happen for the even though the microfinance companies per se may increase their balance sheet size, the microfinance portfolio per se may not increase at the same rate that it had increased in the past. Like Rakesh ji has said that there is a look at doing a secured lending probably lab, housing, or some credit enhancement in existing business loans. These are portfolios that will be looked into by all the microfinance companies. How fast and how quickly they can adapt to this is depends upon each company and their internal policies and the capabilities to adapt to that. But microfinance, so though there will be a growth, the growth would be much less at least this year and probably in the H1 of next year. Whatever growth we will be able to see in microfinance as a quantum, it could be that microfinance companies are increasing their book size, but microfinance book size would be only increasing maybe in the second half of next year, not before that. Having said that, maybe everybody will be looking at, because microfinance being the core sector and the area that each one of us have expertise, be it Vineet or Rakesh, that is the area that we have expertise in. So we would definitely look at that sector and to see as many new borrowers new to credit borrowers that we can bring in, because that is the only segment that will enable us to increase the book size. Considering that already the existing borrowers, we are decreasing our exposure to them, we will not be able to increase our exposure to that. So the capability of increasing the book size will depend on how many new to credit customers we will be able to bring into our book.
Okay, so you're saying it will be more of a calibrated growth because there would be some growth of outside the MFI book and then NTC and so on. And so it will be a mix of all the asset classes over the period of time.
Correct. So we would look at actually having a more balanced portfolio, so that I'm sure all of us would be looking at a more balanced portfolio so that we are sustainable. Because the reason for which Reserve Bank of India has made that 60% qualifying asset is to make the sector sustainable and the entities within the sector sustainable. I'm sure that is what we also as individual entities will be looking to.
Yeah, I would like to just say here that look, you don't find customers for your product, you find product for your customers, right? And therefore, the basic nature of what we do in microfinance, for the grassroots entrepreneurs, we supply working capital for them to continue on their business. We are not asset finance. We don't finance house. We don't finance machinery. We provide working capital. Will the demand go away? No. The demand will remain. Who is going to supply to that demand? Will banks go and supply to the demand in deep rural? If yes, happy. If no, somebody has to continue the bandwagon of financial inclusion. So while on one hand this will continue, yes, we will also try and diversify into other assets from our perspective. But that doesn't mean that we have to stop microfinance, right? Because that is again going to pull all those customers who were depending on working capital financing from this good vehicle will go to what we call as non-formal sector or money lenders. Would we want that to happen? Not really. So it's not that we will be stopping microfinance. We will continue to serve our customers for the need that they have. What essentially will do is companies will try to diversify utilizing their reach, identifying the same customer if they have some other requirement of asset or something. Yes, we are there. But this requirement will continue. It's not that this requirement is going to stop or we should stop supplying to this requirement.
Well, I think that that also was the starting part of our presentation, that this is a grassroots level industry, and obviously the supply of the funding is to grassroots entrepreneurs. So having said that, the latest discussion in the industry now is on the CGFMU credit support. So question to Vinij is that how do you see that, and this is an audience question actually. So whether that would enable a breakthrough in the industry, either as servicing or sourcing. How do you see that product or that offering right now with the industry seems to be welcoming a lot?
I'm sorry, I'm missing your sorry, my
The tool like CGFMU, the guarantee given by the CGFMU. So do you see that as a breakthrough for the sector in terms of servicing the customers or sourcing the customers? How do you see that?
it's a welcome step. It's a good tool. It's a good thing. You can actually uh, use that as a hedge against a certain risk, right? At the end of the day, however, I would say, and I would rather at the fee at our SRO also trying to request that if it can be made more affordable, because for sure, when we take this risk, we are not passing on the cost to the customer, right? We are basically using it ourselves to take care of our balance sheets and develop the confidence to continue to the supply on the same bandwagon. So it's a good move, I would say. Yes, few entities have taken it. Not many have yet gone and registered. It's something which has helped some of the entities, but again, I would not generalize the answers because not many of them have essentially yet availed the CGFMU benefit. But I would say that yes, it's a good thing and people should evaluate it and register and go ahead to continue because at the end, we still remain unsecured in nature and we do remain obviously exposed to cyclicities like any other sector. Any such guarantee schemes are only going to be beneficial in medium to long run.
Yeah, just adding to what Vineet says, yes, we are very bullish on the CGFMU. We have got the license, we become a member of the credit fund, and I'm sure we will be using this for business loans and in the immediate future. And we definitely expect there'll be an uptick of loans under this sector along with the credit guarantee.
Yeah.
Not only this, the credit guarantee for the housing also. Now there is some movement in that, and we also had made a request separately for some relaxed conditions that also would make a lot of difference to the microfinance sector if the small ticket size of housing, there is a separate window that is given for that, and there is an which we can also avail credit guarantee, because that is one segment of credit guarantee that will enable us to do lending also, and lending at a with a lesser cost also. It will enable the microfinance sector to
That's
be
right. Well, the
available.
CGT SME, which is another one, which is there. CGFMU is for unsecured. Yeah, you're right.
But I think you're talking of the NHB scheme, ma'am.
Yeah,
The
that's right.
I
Yeah,
think
that's
the NHP scheme, I think now it has moved to CG, NGCTCME. That is, I think now
correct.
the government is only running it directly. So that also there should be a relaxed condition so that we will be able to avail that for small ticket housing loans.
Yeah, ma'am, again coming to the credit cost and collections, etc. So one is, does the industry use third party for collections, and overall, what is the collection strategy? Means what is the tools that you use for collections?
See, I happen to operate in Karnataka, where we have seen an ordinance on on the misuse of collection agencies. Of course, as a public sector MFI, we have never used an third-party collection agency, nor would we ever. It is not on our board at any period of time to think of it. But I'm sure there are some entities that use it. Only what needs to be done is they should be used prudently and I don't know, Vineet, being
So
a
no,
president
no
of
agency
MFI,
for
MFIN,
last
know better than
regulator.
I do.
Yes, for the last regulation, no, it was very clearly written that MFIs cannot use a third party entity.
Okay.
And in the new regulations, while that has not been mentioned, we know that at SRO, no entity in microfinance, NBFC, MFI for sure I can talk about, Rakesh, please correct me if I'm wrong, uses any third party collection agency in the field. At the most, there can be bots, AIs to reach out to talk to customer, call them to remind of their payments. But in field, there is no third party collections that are being deployed by microfinance entities.
I think that's an interesting conversation, that whether you will consider a bot as a third party or in-house.
Now that you can
Mm.
keep on debating. Tomorrow you
We
have
can do
SMS
that at a
reminders will as
later
a
point
third
of
party.
time. But yeah, something people
But
would
those
not
are,
have.
see, there's a difference. There's a difference. We need to understand that we are catering to a certain set of customers, all women borrowers. We are more cognizant about what we do.
Right.
And that people have to appreciate, because no microfinance agencies use a third party on the field.
Correct. And I have to Rakesh Kumar, there's a question on equity. So do you see PVC interest in the segment? How do you see the equity portion? While our presentation largely said that funding is largely sufficient for the industry, but having said that, do you see PVC interest? What is the status?
See, if you talk to investor, they would always say that you should be more capitalized. But raising capital is not an easy job, especially in this kind of situation. Uh, so, I mean, see, generally, the general answer is yes. I think entities should think of getting capital infused, but it depends from entities to entities. What is their portfolio performance? What is the market? What is the interest of the investors? What is the size and scale? So it depends on various factors. Uh, I think I agree with your presentation, wherein no immediate capital requirement is there for the industry. But at the same time, capital raising is a long term exercise. If I start today, I mean, all of us are aware it takes 8 to 12 months or even more in some cases, including the RBI approval. So I think even if we are thinking today, it will be happening. So considering that, the industry should actively think of, going for capital raise so that they can, continue their business on sustainable basis, and, grow to bring the desired level of sustainability and profitability, meeting the stakeholders'
Yeah,
requirement.
I think the question is on the other side. So are the investors willing, while the companies probably may have their own corporate actions to be taken up individually? But overall, from the investor perspective, do you see a lot of interest coming in from those investors?
Based on my interaction with the investors, I won't say that they are not interested. They are, of course, I mean, they had been waiting and watching, but they had, yes, the extent of interest was, they have put their decision on hold, but now again, they have been interested, they are talking. Uh, I would say, I mean, we need should be a better person in terms of, investors connect. But I guess, there has been good interest from investors world. At least I can see at for, mid-size and big companies. Smaller companies have little struggle in, attracting the capital, that everybody knows, but there has been interest. Yeah, madam, and Vinny.
Just to say that maybe most MFIs are not in such a big hurry to lap up investments, because all our book sizes have decreased. With that, automatically the CRAR has increased. So we are not in such a hurry. what we would have been had the book size increased by 20%. We would have looked for capital more actively. So I think that is one of the reasons that we are also in a position to wait for some time. But of course, for me, investment comes from a different area, not the piece. So I'm sure that is what I would think.
So, ma'am, the question actually is more relevant, less from a rating agency perspective, more from the market. That the level of leverage the market, let's say the lenders or the bondholders, anybody is willing to take up, is lower than what is normal for a leveraged business like a NBFC. Whether it's housing or whether it's MFI, everywhere the lender expectation of leverage is much lower than what it was, let's say, 10 years back or 8 years back. And that we see as a continuing theme, and that is where, so as a rating agency in most sectors, we are comfortable with the leverage right now. But from a market perspective, we had this question. So probably Vineet may have some answer, as Nirja ma'am is saying.
Now you're talking about the leverage expectations of
No,
the.
on the investor interest, on the PEVC interest, or the.
I can't, again, very difficult to generalize, but if you see almost everybody is at a gear ratio about 3.1, 3.5, right? As you suggested. I mean, at the peak of the times, it goes to about 4.5. Depends upon the nature of balance sheet and the nature of the entity, whether it is listed, not listed, or where they operate. Right? That's the typical gearing ratio. In fact, I would say that in microfinance, this is pretty optimal. I mean, look at affordable housing. I mean, you rate yourself enough of companies, you know, where the risk weightages is 50%, but still the gearing ratios are very high. Right? It's also a matter or the element of strategy of the investor in terms of the capital infusion, in terms of how do they look at it, whether they look at it in long term or a short term, in terms of putting the capital in bulk or in tranches. So very difficult to give that answer. But yes, typically, I mean, I'm sure, ma'am, being a part of NABARD, when you're lending, you have your own covenants in terms of gear ratio, right? Which is something which is, I think, mostly expected, actually.
Okay, so we have a lot of questions, but not enough time. So quickly, probably two, three, four lines from each of the panelists. So I'll start with Rakesh, who's one of the, let's say, pioneers in the industry. So when we look at the small MFIs and small companies, what in the current landscape, what would be your advice? Quickly, probably 1 minute, 2 minutes, or something like
The lending business has same fundamentals. Be prudent, right? And considering the business cycles, I think capitalization should be adequate. At least your assessment should be fine. I think all of us have learned that we should be targeting very high growth. We should be setting right expectation with all the stakeholders, and industry is not going anywhere, right? So there is huge demand on the ground, and that is insatiable. So there is huge room for each of the entities and even the new entrant, I would say. Only thing is that you need to be patient, you need to focus on sustainability and decent growth, which is taking care of the balance sheet requirement. If we are sticking to all those lines, then entities in long run will definitely. And also, see, I mean, the capital market evaluates basically the financial services companies good, which is providing the predictable result. So, barring the crisis, if we have to provide consistent result, then we have to stick to the fundamentals rather than chasing very high growth or then stumbling. And I think everybody has learned. I don't see. I'm sure everybody would find some agreement those lines. And the last word, microfinance, I think shouldn't be viewed from very critical lens. Please understand, we are still evolving, we are still small, we are still yet to mature. But if you look at the behavior of the entities and industries, there has been a lot of improvement, crisis after crisis, event after event, and I'm pretty much sure that we will see a much balanced, much evolved industry very soon in 2 to 3 quarters.
Right, ma'am, from your perspective, how would you advise the smaller player, MFI players,
So I
to take
think the
up?
way going forward would be adopting technology as much as possible and as quickly as possible. I think that is the way that underwriting can improve. Be it just simple Aadhaar type KYC and income assessment, or even advanced AI/ML systems that are in place, EWS. All these are very, very important for the industry to function. And as data is the king, and we have to generate as much data for ourselves, not for the industry, so that we ourselves know where we are going right and where we are not where we are going wrong. Of course, from the regulator side, there has been a lot of support over the last year or so. So has been from the government side, because everybody understands, like Vineet had started, that the microfinance is the finance that is available to everybody and at all times. So there is that we have a lot of scope for business. Only we need to do it with technology and prudently. That will be the way forward for all of us.
Okay. So we need, I think, especially since smaller MFIs are having problem, like Rakesh said, the equity also may be difficult to come in. And we know for sure that they're also having difficulty with the lenders, especially the banking system. So how do you suggest, how should they be going about?
So while of course I agree with my esteemed panelists talking about that, uh, see, it's we are, in fact, there was a lot of interest and also focus that the government, as ma'am rightly said, the FM herself had a small group of discussions. There have been an invite done by the Ministry of Economics Affairs for the pre-budget meeting, etc., so that they know that this sector has to continue and do its job, right? There is also something that we are working towards and hopefully may come in terms of credit guarantee scheme so that the liquidity can be ushered back into the sector. But at the same time, while I say all this, on the other hand, I am seeing already the green shoots coming over the last 1 or 2 quarters. In this quarter, the green shoots are being seen, which is recouping the confidence of the lenders back. In fact, the disbursements in quarter 2 are higher than quarter 1, actually, which is actually also shows the a little bit of an infusion of liquidity coming back. The combination of the focus of the government, hopefully the launch of certain scheme, will actually provide the much required platform for the small and medium MFIs to continue make that impact in the field. But one cannot take away, as ma'am rightly said, that the focus needs to be on the governance. Focus needs to be on making sure that the risk assessments and risk analytics in place so that they can take proactive steps in terms of calibrating their approach, in terms of disbursements, in terms of focusing on customers. And lastly, we all need to eventually work on the operating efficiencies because this is where we will be able to pass on the benefit to the customer. These three things have to remain. These will be the only differentiator, irrespective of how big or small we are.
Right. I think that's a good one. That while the industry probably needs some government support, especially on the smaller players, but the players need to also work on their own governance and the business ethics and corporate practices. So while we have a lot of questions, I think we could go on, but it's already been more than almost 1 hour, 15 minutes or something. So I'd like to close this session out here. So over to you. Uh, yeah, Kabir, can you please take over from here?
Thank you, Sanjay, for moderating the session. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the